Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining me for this segment, we have Paul Baiocchi, chief ETF strategist at SS&C ALPS, to discuss navigating a REIT portfolio in a challenging commercial real estate environment. Paul, it's great to see you as always. Welcome back to Trade Talks.
Great to be back, Jill. Nice to see you as well.
You got it. And let's talk about the ETF REIT, REIT. Tell us about the performance.
So performance has been really strong versus your typical REIT benchmark and versus the active and passive counterparts in the ETF wrapper and mutual fund wrapper. And it's largely because the management team, the team that runs REIT, has a tremendous track record of institutional quality research, institutional quality management in the real estate category, and have deployed it in this active REIT strategy. And it's worth noting that they recently changed the format and structure of the product from a semi-transparent chassis to a fully transparent structure.
And Paul, of course, we know the commercial real estate market has been a major focus of investors. There's just a number of challenges that this space faces. What are some of the high-level challenges that your team is taking a look at?
Well, if you look at the Castle Index that tries to measure activity in offices in New York and the various metropolitan areas across the country, you'll notice that that activity index is still well below 50. It's been trending up over the course of the past year and a half or so, but ultimately, a lot of the office space, as I'm sure you see anecdotally, in New York, in San Francisco, in Los Angeles, are still at very low rates. And that's reflective of a population of workers that just hasn't returned to the office in the same earnestness or with the same earnestness that maybe people anticipated coming out of COVID. And it's reflective also, as we've talked about previously, Jill, of a general sea change between how employees interact and interface with each other and their companies. And so when you think about the office real estate space, the reality is that there's a revaluation taking place on office footprints across the country. And the debt tied to a lot of that office footprint is also being revalued. We've seen some office space in Los Angeles that hasn't been refinanced. We've seen companies walking away from big office footprints in some of these major metropolitan areas. And so for investors who are just indexed in the office space or in the REIT space, that can be problematic from a returns perspective. If you look at, say, XLRE, one of the largest real estate ETFs in the market that is passive, a lot of that index is actually in specialty REITs, tower REITs, data center REITs. And we've actually seen that reflected in the active strategy as well, where you're able to tilt away from that office space and maybe wait out that revaluation with the expectation perhaps that there might be some undervalued properties down the road, but we're seeing a tremendous amount of real estate tied debt and leverage that's going to have to be unwound and refinanced over the course of the next couple of years.
And REIT's management team has taken advantage of their active mandate by tweaking certain exposures. Tell us more how they've been allocating and reallocating capital.
Well, what the team has done, the GSI Capital team has done, is they've been able to focus on really strong management teams who have tremendous experience managing through different regimes and different market contexts. They've been able to tweak away from office, as we talked about, towards specialty REITs, towards data center REITs, towards tower REITs. And that's allowed them and has been enabled by really the flexibility that an active mandate provides. So when you think about just being benchmarked in the real estate category, a lot of folks have overweight exposure to some of those categories, but because they have a highly concentrated portfolio of less than 30 names or so, focused on those strong management teams and those categories that they really like from a valuation perspective, they're able to generate strong relative performance. And one other point I'll make here, Jill, that I think is really important is that when investors are thinking about the decision on a strategy like REIT, it's not just REIT versus the index, it's private versus public. And if you look at public REIT valuations, they're still trading at significant valuation discounts to net asset value. Whereas on the private space, we've heard about people trying to get out of some of these private credit strategies, and private real estate has traded at this pretty durable premium to the public counterparts. And for most investors, public REITs are the appropriate way to allocate to the real estate segment.
All right, Paul, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq.
My pleasure.